In the late 1990s, the internet is a brave new world, and everyone wants a piece of the action. People are quitting their jobs, pouring their life savings into companies with names like Pets.com and Webvan. The NASDAQ is soaring, minting millionaires overnight. It felt like a gold rush, a digital revolution where the old rules didn't apply. But what goes up must come down. This is the story of the dot-com bubble, a tale of incredible ambition, dizzying heights, and a spectacular crash that changed the world forever. The story begins in the mid-1990s. The World Wide Web, once a niche for academics and tech enthusiasts, was going mainstream. Companies like Netscape, with its groundbreaking web browser, showed the world the internet's commercial potential. Their IPO in 1995 was a blockbuster, doubling its stock price on the first day. This set off a firestorm. Investors, both seasoned venture capitalists and everyday folks, were gripped by a new kind of fever. The logic was simple, or so it seemed. Get a .com domain name, create a website, and you were on your way to becoming a billionaire. The mantra was get big fast. Profit didn't matter. User growth, website traffic, eyeballs. These were the new metrics of success. The belief was that once a company captured a market, the profits would eventually follow. This led to some truly wild ideas. You had companies like Pets.com, which promised to deliver pet food right to your door. They spent millions on advertising, including a famous Super Bowl ad with a sock puppet mascot. There was Webvan, an online grocery delivery service that built massive, high-tech warehouses aiming to replace the supermarket. And Cosmo.com promised one-hour delivery of anything from movies to snacks. In major cities, the hype was everywhere. Business news channels buzzed with stock tickers climbing ever higher. Magazines hailed tech CEOs as the new rock stars. It felt like an endless party, fueled by easy money from venture capital and a soaring stock market. The NASDAQ Composite Index, packed with these new tech stocks, skyrocketed from under 1,000 points in 1995 to over 5,000. By March of 2000, people who had never owned a stock before were now day trading on their home computers, convinced they had found the secret to infinite wealth. But beneath the surface, cracks were starting to form. Many of these dot-coms had a fatal flaw. Their business models were unsustainable. They were spending enormous amounts of cash on marketing and infrastructure without a clear path to profitability. Pets.com, for example, was losing money on every bag of dog food it sold because of high shipping costs. Webvan's expensive warehouses were operating far below capacity. They were burning through cash at an alarming rate. A few skeptical voices, like economists Robert Shiller, warned of irrational exuberance, but they were largely ignored. Why listen to Kasha when your neighbor just made a fortune on a stock for a company that didn't even have a product yet? The party seemed too good to stop. The turning point came in March 2000. The music finally stopped. A series of events triggered the collapse. Japan entered a recession, and a major court ruling against Microsoft sent jitters through the tech sector. Suddenly, investors started asking a question they had ignored for years. Where are the profits? Fear replaced greed. The sell-off started as a trickle and quickly became a flood. As stock prices fell, the dot-coms that relied on a high stock price to fund their operations found themselves in a death spiral. They couldn't raise more money. They started laying off employees, then shutting down completely. The NASDAQ began its brutal descent, wiping out trillions of dollars in market value. The fallout was immense. By 2001, the digital landscape was littered with the wreckage of once promising companies. Pets.com, which had gone public just 9 months earlier, shut down. Webvan declared bankruptcy. Its futuristic warehouses sold for pennies on the dollar. The dream of instant riches evaporated, leaving behind financial ruin for many and a deep sense of disillusionment. Thousands of talented tech workers in Silicon Valley and beyond were suddenly jobless. The era of get big fast was over. But here is the crucial part of the story. The crash wasn't the end of the internet. It was a painful, but necessary, correction. The bubble wiped out the unsustainable ideas, the companies with no real business plan, but the core technology, the infrastructure, and the truly valuable ideas survived. Think about it. The companies that rose from the ashes were the ones that had focused on solid fundamentals. Amazon, which was often criticized during the bubble for its spending, survived by focusing relentlessly on customer experience and efficient logistics. eBay survived because it created a real, profitable marketplace. Google, founded in 1998, quietly built a superior search engine and a revolutionary advertising model while the bubble raged around it. The dot-com crash taught the world a valuable lesson. Technology alone isn't enough. You need a sound business model, a path to profitability, and a focus on creating genuine value. The ideas of the dot-com era weren't all wrong. Many were just ahead of their time. Online shopping, grocery delivery, streaming media. These are all thriving industries today. The bubble's failure paved the way for the success of companies like Netflix, Uber, and a whole new generation of tech giants. So, while the dot-com bubble is remembered as a spectacular failure, it was also a crucible. It forged a stronger, smarter, and more resilient tech industry. It was a dramatic chapter in the history of innovation, a reminder that progress is often a cycle of boom, bust, and rebuilding. The echoes of that boom and bust can still be heard today, a cautionary tale for any new technological revolution. Thanks for watching this journey back in time. If you found this story fascinating, please hit that like button and subscribe for more deep dives into the events that shaped our world. Let us know in the comments what you remember from the dot-com era. See you next time.